What's up, guys? My name is Nick, and in today's video, I'm going to be talking about some of the most important investing tips that you guys should know. This is going to be a very important video, so I encourage you guys to watch it all and take notes. And as you can see, my portfolio is at 47,702 and 64 cents, which I believe is an all-time high. For the week, I had a gain of $355.35, and I earned $26.29 of dividends, which is always nice to see. And if we just go over to my portfolio real quick, you can see AbbVie was the top stock of the week, and which looks like Texas Instruments, which is one of my favorites, was the bottom stock of the week. Now let's go into my activity feed. If we start at April 4th, I received a $2.33 dividend from Walmart, and I also deposited my regular $125 a week. And it looks like on the 4th, I had 5 buys, which were Texas Instruments, Home Depot, Microsoft, Pepsi, and Costco. All great stocks that I love to buy. Next up on the 6th, we had a dividend from Jeppy, an amazing dividend, $20.52. They had a huge payout, which I love to see that. Then on the 7th, I received $8.02 from Merck, and I also had 2 buys on the 8th of Microsoft and Texas Instruments. And with that being said, guys, let's get right into this video. So these are important investing lessons that you should know. Let's go right to number 1. Think long term. So when it comes to this, I know in the past couple years, people have been investing in stocks like GameStop, AMC. They've been buying meme and hype stocks. People have been doing whatever they can in the stock market to get rich quick. And, they would do stuff like day trading or also buying high yield stocks. My advice, my recommendation is that the stock market should not be something where you get rich quick. It's where you get rich eventually, and it's where you build long-term lasting wealth. And I think when people were buying all these crazy like penny stocks, hype stocks, crypto penny stocks, all this stuff, they weren't looking at the fundamentals. They weren't looking at great companies that were increasing their revenue. And I believe that's going to hurt you in the long term if you do that. And so here's a quote I found. It says, saving your money is putting your money to rest. Investing your money is making your money work for you. So if I go over here, you guys you've seen this chart with my monthly dividends, and you've seen how it's gone from, $5.78 in the first month that I received my dividends to all the way to today where I'm earning $195.96 on average every single month. And so this shows you that when I look at my portfolio, $195, almost 196, it's not a lot, but I'm not thinking about my portfolio today. I'm thinking about it in 10, 20 years. In 20 years, I'll be 50, almost 49, almost 50. And I don't think I'm going to want to work when I'm 50 and beyond. So when I look at this now, in just 2.5 years, I'm already earning almost $195 a month. And over the next couple decades, as I increase my income, as I invest more into my portfolio, I could be making 3, 4, maybe even 5 grand a month. And that's what I'm looking at. That's my goal. My long-term goal is to be able to live off of my dividends, pay all my bills, and have a great lifestyle. And that's why, if you guys will notice, if we look at my portfolio, I own a lot of boring stocks, but these are stocks that perform well over long periods of times. They allow me to just keep building my wealth and keep earning that dividend income. So next up, the second lesson is to control your emotions. Think of your portfolio almost as a business. Think about each of these stocks as your employees or as rental properties, and they work for you and they pay you every 3 months, every month, however your dividend stock pays you. And to give you guys an example of this, the reason I actually started investing was Coca-Cola stock. But I'll go back to my portfolio. If you look at it, do you see Coca-Cola stock? No. And when I say I started investing because of Coca-Cola stock, I mean that is the exact reason. I loved Coca-Cola, their drinks, their products, the dividend. When I was researching, I was looking at Warren Buffett, how he bought Coca-Cola. That is why I got into dividend investing. But I sold Coca-Cola without any hesitation because Pepsi's better. I've done the research. I have prior videos where I show you why I bought Pepsi or why I held Pepsi and sold Coca-Cola. Because when it just comes down to it, it's a better business decision in my mind to own Pepsi. And I'll give you another example. AT&T, I believe it was one of my first 10 stocks, just like Coca-Cola was. But I sold AT&T without any hesitation because they did two major things. They decreased their dividend by 50%, and they sold HBO, which was their streaming service, which streaming services, getting that subscription income, that's a great business to be into. And I just didn't appreciate when AT&T did that, when they got rid of it and when they cut their dividend. So I sold them immediately. And also with controlling your emotions, you really have to remember why you bought a stock, because if the stock falls, you don't want to just sell it just because it fell. You want to sell your stocks, like I mentioned before, if it doesn't align with your goals and if they change their business significantly. So just remember, do your due diligence when you're buying your stocks. And if it's a solid company and you know that they'll perform well over the next decade or so and you've got time, don't feel bad if it drops, especially in a market crash. Everything's going to fall. Don't worry about it. We'll get out of it. And another thing I want to point out with this tip is there's a quote where it says, only invest money you're willing to lose. And I absolutely hate that quote, because to me, that quote says that you're going back to the first step, you're not thinking long term. When you invest your money, you shouldn't lose any of it. To a point, like I said, if the market crashes, you're going to lose money, and I'm doing air quotes. You only lose your money if you sell your stock at a loss. So when I think of this quote, only invest money you're willing to lose, I'm thinking that you're not doing the fundamentals, which should be paying off or creating a budget, paying off high interest debt, building a 3 to 6 month emergency fund, and then investing in solid companies. Like, even though I told you guys that I sold AT&T, sold Coke, if you look at my portfolio, majority of my stocks are blue chip stocks. Like, I don't lose when it comes to the stock market. Because even right now, as the stock market is dropping over time, my dividend income is still increasing. So the overall goal of my portfolio, that passive dividend income, it's increasing. So I don't believe that my stock portfolio is losing. And so I want to go over the next investing tip. Just remember, control your emotions, do the fundamentals, do your research, and you won't have to worry if your stock drops because it'll only be temporary. Next is to start with lower risk assets. And when it comes to this, I want you guys to create a solid investing foundation. So something I don't show you guys a lot, or I've never shown you guys, is my 401k. And basically my 401k, I invest everything into the S&P 500. That is my solid foundation when it comes to investing. Another thing is I can show you the first 10 stocks I ever bought. And you can see AT&T, Clorox, Coca-Cola, Colgate, Costco, Johnson and Johnson, McDonald's, Microsoft, Pepsi, Walmart. And of course, three of these stocks I no longer own: AT&T, McDonald's, Coca-Cola, because when it goes back to what I was telling you before, I made a business decision to not own those stocks because they did something along the line that I don't agree with and that I don't think will help me in the long term. But now going back to creating a solid foundation, even if you look at all these 10 stocks, they're still great companies. Like even though I sold Coca-Cola, I'd say they're still a great company. Not great enough for me, but they're still great. McDonald's, a little iffy. They're still earning money. They're still a good company, I would guess. AT&T as well. But this is a very solid foundation when it comes to investing, especially when I look at stocks like Walmart, Pepsi, Microsoft, Johnson and Johnson, Costco, Colgate, and Clorox. This is a very solid foundation, and I did research over a month before I even chose these stocks. And that's why I still own over 70% of them, because I believe that they are going to be great for the long term. And another thing I want to say is don't start with those high speculative stocks. Don't invest if you're just getting started with investing, don't do meme stocks, don't do hype stocks, don't do IPOs, SPACs, all this other like crazy stuff that I don't know about, or even high yield dividend stocks. Because the thing is, when those crash and when those fall, as they are now, you're going to get demotivated when it comes to investing. You're not going to like investing. There's plenty of people who probably bought crazy stocks during 2000, during the tech bubble, and they lost a lot of money and they just quit investing. They said, "Oh, I lost all my money. This is too dangerous. It's too risky. So I don't want to do it." And so that goes back to my point of having that solid foundation with great stocks. You did your due diligence, you did the research, and when you own these stocks that continue to perform well, it'll motivate you to invest longer, and overall that'll increase your gains. So then fourth tip or fourth lesson is don't risk it all on one investment. And while this is pretty self-explanatory, don't put all your eggs in one basket. There are some people who have over 50% of their portfolio in one stock, which I do not agree with. Even if you go to my favorite stocks, if you had 50% in Microsoft and 50% in Costco, even though I believe those stocks will be here long after I'm gone, I still think that's too risky. I don't agree with it. The only time I'd say you can put 100, even 100% into one stock would be an index like the S&P 500 or the QQQ or something like that, because those index own a large majority of stocks. So what my advice would be for this point is try not to have more than 20% in one stock or 20% in one industry. And this will protect you if either of those fall. If one stock falls, you have another 4 stocks to keep you up. Just like if one industry falls, you have the other 4 industries to hold you up. And now if we go to the final lesson, it is to invest regularly over time. So have a plan when you start investing. I'll be honest with you, I did not have a plan, and it hurt my portfolio in the beginning. I would just invest my money whenever, here and there, $100 here, 200 there. And there was a few months where I didn't invest at all. Now, to be honest, I was investing into my emergency fund. But if I would have planned it better, I could have still invested $125 every single week like I do now, and still invested into my emergency fund. So that actually hurt the growth of my portfolio. If I go back to my chart, I can tell you that those months that I didn't invest, probably from, I think it was February to May, maybe even June of 2020. So that's a large chunk of time that I just did not invest. And then after I had finished my emergency fund, which I originally got to $10,000, I decided that was too much for me. And then I dumped all that money into my portfolio. And that's when you see my portfolio just make record after record breaking month of passive income and dividends, is because one, I dumped half of my emergency fund in there because I only needed about 4,600 to 5K in it. And then I started investing consistently. I think it was in October when I decided to start doing 125 every single month. And that was October of 2020. And I've been doing that ever since. And so guys, those are my top 5 investing lessons. I've learned a lot from these, and I think you guys can too. So just to go back over them, think long term. Don't think about getting rich quick. Control your emotions. Do the research. Remember why you bought a stock and hold on to it, because in the long run you should be fine. Next, start with lower risk assets. I encourage you guys to start the foundation with something like the S&P 500 or even maybe SCHD, even the QQQ. It's fine with that. Number 4, don't risk it all on one investment. Like I said, don't put all your eggs in one basket, and invest regularly over time. Consistency is always going to get you to the finish line. So guys, thank you for watching this video. Don't forget to like the video if you liked it. Comment down below. I'll be answering all your comments. And unfortunately, M1 Finance is not giving $50 when you sign up. They're going back to $10. It's still $10, still free. So go ahead and sign up. However, Webull is giving $5 when you sign $5. Well, $5 in crypto, but 5 free stocks. So guys, thank you for watching the video, and I will see you next week.